Welcome to the Value Investor TV podcast. This is the podcast that helps you grow your wealth and become financially independent. My name is Becco and my partner, Hari.
Hello.
I like your shirt right there, Astrodome.
I don't know if they can see it, but...
Staying true to the Houston roots, Hari.
Yeah, it says everything that is not lost will... Or everything that is... not saved will be lost. So both a reference to the Astrodome and to your Nintendo save game.
Oh, yeah. I like the pixelated image.
Yeah.
Awesome. In this episode, we will be talking about return on equity in asset-light business, such as software.
Yeah.
And why this is such an important concept. And why it is slightly different here in this industry, asset-light industries, such as software. Why do we need to look at return on equity slightly differently? We will talk about in this episode.
Yep.
Before we do that, though, should we do a quick disclaimer, Hari?
Yeah. So this podcast is an educational podcast designed to help you learn how the value investing works, and it is not a podcast that is giving you specific recommendations on what to invest in. We want you to learn how to do that, and if you have any specific questions about your own financial situation, you should consult a financial advisor.
Perfect. All right, let's dive right into this. I think before we start, though, I think what could be nice is if you could kind of summarize quickly what return on equity is, kind of definition, why it is important, kind of generally, and we can dive into asset-light business down the road.
Yeah. So we had talked about in the last episode, a return on equity as excuse me, net income divided by shareholders' equity. So net income is the bottom line of your income statement. So after you subtract out all of the expenses, this is what the accounting profit is for that particular quarter or year. And then you take the balance sheet and look at the assets minus liabilities gives you the equity. So what you own minus what you owe equals your equity in a business. It's not unlike your the equity in a house. It's the same concept, right? The house is the price of the house minus the debt, the mortgage payment equals your equity. So that is what you as the shareholder own in the business. So we had talked about shareholders' equity as something that can be slightly manipulated with debt. So if you have a lot of debt, you can lower the amount of equity, which means that you have an asset minus liability, the liability is higher, so you get a lower amount. So then your return on equity is something that is kind of artificially inflated, right? So whenever we talk about return on equity, you may see numbers that are high, like 100%, 200%, but it's because the equity base is skewed due to debt. So if you see that, the kind of the rule of thumb that we look for is debt to equity ratio is less than 1, or the company has the ability to pay off all of its debt with free cash flow in about 3 years.
Yeah, I think those are kind of good rundown of what return on equity is, kind of the edge cases that Hari talked about. I think those are really good, really important to kind of keep in mind as you analyze companies. Yeah. And, so with that said,
I was going to say, Becca, it may be worthwhile also to explain to our listeners why what is this actually measuring, right?
Yeah, sure. Yeah.
So return on equity is really a measurement of profitability in the company, right? So companies that have a return on equity is essentially saying, for every dollar that I invest, how much do I get back in the business, right? And that's what this concept is really telling you is how much money do I have to spend to gain this? So, if I were trying to copy this business in order to get a rate of return, Now, there's some vagaries in the laws of return on equity or how GAAP accounting rules work. And think of a business like Macy's, who's owned its flagship New York store for over 100 years. So they may, that asset is basically off of the books because it's depreciated out over time. And so, and the land that it was purchased, on and built was actually purchased at the price that it was purchased. So that was 100 years ago. So that's I would imagine in 100 years has grown by significant amounts. So equity is not a perfect measurement because of the way the rules work. You don't get to assess the value of these assets over time. They are just at the carrying price, and then they get depreciated away over time. And so you sometimes see businesses like Macy's that has a high return on equity, even though their return on equity is actually for assets that they've owned for a very long time, right? So that's another kind of way that you can see these numbers tweaked, right? Whereas newer businesses don't have any of those rules, benefiting their, or upping their return on equity.
Yeah, I think actually, if I can summarize right there for our listeners, I think those 2 points, edge cases, are really important to kind of keep in mind. First edge case that we talked about is companies with a lot of debt. Return on equity is going to be artificially high because of the debt that is involved. So that's one case. The other case that Hari just talked about there is if you have an asset base that has been depreciated away for a long time. For example, Macy's is a good example. Your return on equity is also going to be inflated. So when we talk about return on equity being kind of end all be all, it is not end all be all. Actually, it is a measurement that you have to understand, but you have to take this context into account when you're looking at these numbers.
Yeah, and to give you guys some more flavor on this, Becco and I are both programmers, right? We understand programming and how it could help us find these great businesses. By screening methodologies and things like that. And the problem with using those is that if you don't capture all of the flavor of these, various things like Macy's or you have to, modify the return on equity using debt, calculations and stuff like that. So it's not as easy to just sit there and capture information, using this. That is why we have a checklist. That's why we go through it with every investment that we do, which, by the way, you can get at info@valueinvestor.org, or you can tweet us at valueinvestortv, and we're happy to send it to you. Or if you have any questions, by all means, send it to us through those channels. But the purpose of what we're trying to get you guys to understand is, like we talked about in the earlier topic, or in the last podcast, this concept is super powerful, even though it has all these gotchas, right? And you can't just necessarily look at one number every year and just say that's the return on equity. It'll fluctuate every year, and it'll have vagaries that change it. But it's such a good method of identifying how quickly a business can grow, because that return on equity is how much money gets generated based off their equity base, and then if they plow all of that back into the company, you will see that rate of return over a long period of time, right? So if they grow, if they have a 20% return on equity, that 20% that's what their long-term growth rate will be, right? That's super critical to understand.
Yeah, exactly. I mean, this metric is very, very important, as we have been kind of iterating and trying to hammer it to you guys, hammer it in. It's such an important concept, and that's why I think before we actually move into the topic that we wanted to discuss, we don't want to take too much time here, but these are concepts that is really important to kind of highlight. I also want to point out that if you see companies where your management's incentive structure is tied to any of these kind of operational efficiency ratio, return on equity, return on invested capital, those are really good things. I like to look at management incentive structures quite a bit, because incentive structures are powerful motivators. And if you look at incentive structures and they have return on equity or return on invested capital in there as part of their kind of target for the year or for the quarter, that's a really good thing for me.
Yeah, and that the higher that return, in a business that has the ability to grow, the faster it'll grow. I mean, that's
Like,
a fantastic thing, right? When you really think about it.
yeah, exactly.
It's the ability to continue to grow quickly. So,
yeah.
all right. So what
Should we move?
Yeah,
let's move on to the main topic of our podcast. So this topic was kind of brought up by Hari. He had an epiphany, and I think it's a powerful concept. It's an amazing, amazing concept. So if you could just take us through how you kind of got this insight, because I think it's a powerful concept.
Well, so I mean, I'm not going to take credit for it. I mean, there are lots of people who are talking about this, but when you think about a business, right? We have talked about the equity base heavily, right? That's something that can be manipulated, by debt, by other things, right? And there are other ways of measuring this more efficiently. But really, what we are getting to the heart of is, our the world that we live in is moving more and more towards an asset light business model, right? So that means, technology doesn't have, a whole lot of hardware that they're purchasing. They're not, spending a lot of money on, physical infrastructure. I mean, there are some businesses that are, but for the most part, technology is a asset light business, right? That means they're not spending money on the equipment, but they are having to spend a lot of money on people, right? And the people part of this is the other side of the equation, right? So if you have a lot of money that is spent on your people, what you're seeing is an expense that is occurring year one, year two. Well, if you think about research and development, right? Research and development is something that you pre-spend for, right? You're going to take that money and spend it on year one, but you won't see any return on it until year 2 or 3, right? So you'll see a lot of companies that will have a temporary rise in their operating expenses, and that will lower their return on equity, right? And so when you see that occur, what's happening is they're ramping up to build out a future, growth, right? And so it makes it a lot harder to assess those kind of businesses. Think about Amazon early in the 2000s, right? This business, so Jeff Bezos figured out that every dollar after his gross profit is essentially business investment, right? So he can take that money and invest in newer products, building new things out. And that's all people, right? So he hires a bunch more people to do stuff. So you saw that Amazon had a very thin operating margin, right? But a lot of that was money that was being spent on building out new things. So in 2008 or 2009, they released Amazon Cloud Services, which allowed them, AWS. And so that was a build out that occurred because of all of their spending on infrastructure, prior to 2008, right? And that may have taken them 2, 3, 4 years to build out. And then you didn't see much of a profit until afterwards, right? And then in 2008, Amazon, which was, there was a great article in, I think it was the Wall Street Journal recently that was showing Amazon versus Uber in year 10, right? Or year 9, I think they were. So Uber is 9 years old, Amazon at 9 years. Amazon had a very thin operating profit, few $100 million. Uber has multiple billions of dollars in loss, right? And, when you looked at what Amazon was doing, they were taking essentially all of their profit, and instead of seeing it as a capital expenditure, right, which is what we would normally look at, and that's where we would see this, big CapEx expense. What we're instead seeing is a huge operating expense. And we're thinking about it, if you're looking at it in at a very high level and you're not paying attention, you're not reading the annual report, you're not reading what that money is being spent on, what you would see is, oh, this is a low return business because they're spending all their money on the return, on the operating side without any real, I don't see any profit being generated, right? So it looks like low return business because all of the operating profit is taking it out, right? if you look at another good example of this, and it's not even a tech company, was Skechers, right? Skechers in the last 2 or 3 years was saying we need to ramp up heavily to build out for these new emerging markets, China, India, and so on. And when we talked about the company, you saw a much lower profit. Their net income did not look like it was growing, right? And they were spending a lot of money on their e-commerce infrastructure, so tech side of things, and they were also spending a lot of money on people in various industries, like in China, because they couldn't afford. It was not about a capital expenditure; it was about that. So, why this is such an important concept is, you may look at a business and say, "Oh, wow, they have a super low rate of return," and then you pass on that industry, right? Or you pass on that company. And then when the actual leverage occurs, when they actually take that money and it's now generating a ton of profit, everybody's already caught on to it, right? And so you miss the boat on this kind of business, right?
Yeah.
That's the what we're trying to help you understand. So go ahead, Becco.
Yeah, I think when you told me that, I was kind of mind blown. I think that is a powerful concept, and I think for our listeners, maybe a good way to kind of, because we threw out a lot of kind of terminology, operating expense, CapEx. If I could just summarize at high level what they are. CapEx is, you can find it in cash flow statement. It's at the bottom, the last kind of financial statements that you oftentimes see. The capital expenditures are kind of hard assets that you purchase. So for example, if you're hiring somebody, that's not a CapEx. So you won't see that in the CapEx line in the cash flow statement. So CapEx is hard kind of assets that you're purchasing that's going to increase your asset base. That's what CapEx is. Operating expense, on the other hand, you can find it in the income statement. So it's the operating expense of running your business. So for example, hiring somebody, like we talked about, that example would belong in the operating expense. So what Hari's talking about is, for tech asset-light businesses, you're not going to have a lot of CapEx, right? You're not going to buy a whole bunch of equipment to run a software company. What you're going to do instead is you're going to invest in people. You're going to invest in, operating expense. So if you're just looking at, asset-light businesses from this conventional kind of thought, you're going to miss the boat, like Hari talked about. So that's kind of what we're talking about at a high level. I just wanted to touch on those kind of definitions.
Right. And I think the important thing is, I get a lot of people who come up to me when we run our value investor meetup, and when we get this from, various emails and things like that about, the screening methodologies that we use to find all these companies. And what I will tell you is, if you don't read the annual report, you're not going to be able to know what this company is doing, right? You may see a dip in operating profit, and you may say, well, that's because they're, times are bad, or, things aren't working out, or whatever, right? But that's not actually what's happening, right? The company may be investing in its people to launch a new product, to get, things out the door, and then you don't see any return on that, right? And so it's not about building infrastructure, physical infrastructure. It's about, in an economy like this, in a tech economy, you're going to have a lot more asset light kind of things. Now, the return on equity is still the same, right? If you lower the operating expense, you're lowering your return on, or lowering your operating profit, you're going to lower your return on equity, right? But what we're really highlighting here is, in an asset-light business, you need to be paying attention to what are they actually doing on the operating expense side of the house, and find, is that going to actually turn into profit, right, in the future, right? So building a new business line, building new software doesn't guarantee that you're going to succeed, right? You may build something and it may be the Amazon Fire Phone, which was a failure, right?
Disaster.
Yeah. So, but you may be spending money, and it may not be clear what you're spending it on, right? But you need to look at the annual report, pay attention to the conference calls, pay attention to what people are saying, because then you can kind of identify what that money is being used for. And you may see this very low, return on or very low amount of money spent on capital expenditures, but you'll see a ton of money being spent on the operating side. And what it does, which is why it's confusing to people, is their earnings per share will get affected, right? When you spend on capital expenditure, earnings per share is not affected at all, right? And so you see companies that have the just so you to understand that concept, net income is divided by shares outstanding is the earnings per share, right? And that's affected by how much money is being spent on the operating side. But on the capital expenditure side, that is occurring in the cash flow statement. That's occurring after your earnings per share has been, identified, right? Both are important. Both are important expenses. And if you're not spending enough money on the CapEx side, or you're spending a lot on the CapEx side, it affects your free cash flow, right? The free cash flow takes into all of those into account. But what doesn't take into account is if you're spending money on the operating profit, your earnings per share will be significantly diminished. You look at Amazon during the 2000s, their operating expenses were very high, had low operating profit. But what they were doing was taking the money out of the, from the business that it was generating and plowing it back into new businesses lines. And you couldn't see that. And if you just looked at it and you said, wow, they're trading at a PE of 100. Well, they're trading at a PE of 100 because they're spending a lot on operating profit. And the future is where they're going to make up all of that. And now you look fast forward to 2018 and they're generating $10-15 billion in net income, because now that all of that investment is paying off, right?
Yeah. Not to mention all the tax benefits that they're reaping.
Yeah, they're not paying any taxes because they had a tax loss for so long. And now it's kind of, they can't avoid it. So,
yeah. It's a really powerful concept. And I think that right there, what you talked about, understanding kind of the fundamentals of the business, understanding, opening up 10K and actually reading through the business, seeing reading through the comments in the annual report, reading through the comments in the transcripts, the conference call is so important. And that's why value investing is hard, right? You can't just digitally or programmatically screen things. As much as we would like to, it's not possible. So you need to really put in the work if you want to be a good value investors. And people who, we're kind of seeing it now, right? With Amazon, if you have found that, if you have kind of understood this kind of nuance, it would be hard. But if you kind of understood this nuance, you're seeing kind of the growth of a major company, rise out of nowhere.
And by the way, Warren Buffett and Charlie Munger didn't see that, right? They missed this, right? Not that this specific part of it, but they missed Amazon, right? They didn't see it being that thing, and they'll readily admit that, right? Obviously everyone, I missed it. A lot of people who were thinking about this said, they barely make a profit, right? And they then use that to compare it to Uber, right? Which is, Uber was not profitable. Well, that's not true. Relative to Amazon was actually profitable. They were profitable after 3 or 4 years of their existence. But all of the money was being spent on the operating profit side. But they still had we're breaking even. Uber is spending money, left and right, and they have no operating profit, right? So, their return on equity is super, super negative because, whatever they've built up on an equity side is being, destroyed by the, by the fact that they're subsidizing every ride, right? So, I think this concept is really powerful because as you analyze companies, there are hidden gems that are hidden because you're not properly measuring their profitability, right? And if you can identify those companies and then identify what the profitability will be, you have a potential, big win, as that company gets going. Becco and I, excuse me, have been looking at a company that we don't talk about specifically investments that he and I have made on the podcast, because we don't pump companies or do that kind of stuff. But they were doing something very similar to what we were talking about, where they're investing heavily in a business. In a new line of business that is very software heavy driven. And that means that they don't have a all of it is affected in the operating side, and they still maintain very high operating margins. But what we're seeing is, leveraging up of that, because it's actually lowering their return on equity, right? Their traditional return on equity had been much higher. It's gone down, but that is because they're investing so heavily in that operating side of the house. And we will see that leverage up here in the next few years.
Mm-hmm. To me, that's what's exciting, Hari. Like, this is, at value investing, to me, it's really finding these true gems that are hidden, right? And so once you find them, once you identify them, investing with conviction, and until, investing with conviction, and then, be patient, and that thing just takes off. That's where the true joy is, in my opinion.
Yeah.
And it's hard to describe the kind of the feelings.
Yeah. The money's good too.
Yeah, money's great. Money's great.
But but that feeling of finding a great business that, other people are not, not seeing for what it is kind of a great, thing, that you have this like secret, and that you can't, you can tell everybody, but no one believes you. And then 5 years from now, everybody looks at you like, I wish I had known that. I was like, well, I was telling you, to look for these things. And that's kind of why what we want you to learn, right? Is this idea of identifying those businesses. Because look, this podcast, who knows if it's going to be around forever. We're not here to tell you individual companies to invest in. You find those businesses, you find companies that you understand, and you will see that, where they're investing and how they're using their money, how they're allocating their capital, right? Which is such an important part of this concept. And then you will start learning what good businesses are, and then you will start finding these companies. And it looks like a daunting task, right? But it really isn't. If you spend the time, I think you will find them. And you will gain all of the reward from doing that hard work, I think.
Absolutely. It's such a powerful concept. Return on equity specifically in asset-light business, I think it's a powerful concept. All right. I think that's kind of it for us. Anything you want to add before we close out, Hari?
Yeah, there's one final thing I want to say about this, to add to this return on equity concept, right? Is that we had talked about the business where you expand the equity base and then it slowly grows over time. There's an even better thing than that, which is a company where you don't even have to spend money to see it grow.
That'd be crazy.
Yeah, so think about Microsoft in the 80s, right? They would stamp Office CDs, right? You make the first copy of Office costs $10 million or whatever it was, right? The second copy of Office costs 2 cents, right? The cost of making a box, right?
Yeah.
And so the more they sell, the more money they make, right? But it essentially is a concept of being able to make more and more money without spending any more, right? That is the ideal business, right? That you can make money without reinvesting it. So Buffett and Munger gave the example of See's Candy, right? So they bought See's Candy for $25 million net in like the 70s. And they've since spent $40 million, have been reinvested into the business in 50 years, right? 40, almost 50 years. But the company has returned over $1 billion to them in that time, right? In terms of profit. So they don't have to reinvest that money to make money there, right? And that's really, really powerful, right? So that's the ideal scenario: is can they continue to grow without reinvestment? Most businesses don't work that way, right? So
yeah.
But if you can find a business that does, which software is a great place to look, right? You can find businesses that do that. Then you may have a winner, right? The Apple has that same concept, right? That they have a per price for making the iPhone, but then they sell services and they sell other equipment and all this stuff, and they pull you into an ecosystem. So without reinvestment, they can still grow and generate a ton of money. So,
yeah. And that kind of goes back to our discussion around competitive advantage,
Yep.
right? But that's a separate topic altogether. Excuse me. All right. I think that's it for us today. This episode. This was really enlightening episode for me. I hope it was enlightening for you as well, our listeners. And please send us email. Send us any comments, any questions, any suggestions for the podcast. Please send us emails at info@valueinvestor.org or just tweet us at Value Investor TV. That's our handle. So info@valueinvestor.org email, and Twitter handle Value Investor TV. So reach out to us, send us any questions, and if you would be so kind, please leave us ratings on Apple Podcasts. Any review there would really help us get more visibility in this podcast scene. Hari, anything else before we close out?
Nope. Really appreciate everyone's feedback. We've gotten a lot of kind words from a lot of our listeners, and that really helps us. Makes us feel good. We like warm fuzzies, but it also is nice to hear that people are getting stuff out of this, and makes us want to keep going. So,
yeah, exactly. Awesome, guys. Thank you all for listening, and we'll see you on the next episode.
Yep, thanks.